Good morning, everyone. All right, so we are going to commence this webinar, and our today's topic, as you all know, is expectation gap in auditing, right? So today we are going to talk about what is an expectation gap when it comes to auditing. There are expectations. People are different stakeholders, business people, bankers, shareholders, senior management, investors. They would have different set of expectations from the audit report, right? Now, the reality is the audit report and what the auditors do in terms of external audit is not what they're expected to do by all the stakeholders. And this is exactly what is called expectation gap. Then we are going to discuss how, what are the reasons which basically lead to these expectation gaps, and then in the end we will see how to mitigate this gap so we do not have to have this gap, which is not a desirable thing, right? All right, so companies have financial statements, right? They prepare their financial statements, they need to see their profitability, they need to see their assets, liabilities, they need to see their shareholders' equity, and then they have to see their cash flow statement. And so basically, all in all the companies have to prepare their financial statements. That gives them the financial position of the entity's affairs, right? Now, when we prepare it, it has to be analyzed by an independent third-party qualified auditor, right? Now, what happens is when they get audited, the stakeholders, there could be a number of them, we're going to go through it one by one, they all rely on the audit report in many ways. And that leads to expectation gap, okay? So first of all, shareholders, they are one of the biggest stakeholders, and they need to see an audit report. What do they mean by audit report? What are their expectations from the audit report? Secondly, the second group of stakeholders could be investors, okay? What do investors want from an audit report? Is it for them to rely upon while making their investment decisions? And then for bankers, for example, financial institutions, the creditors, when they lend money, they rely on audit report. What is it for them? Is it for that specific purpose? Can they rely on it? Regulators, a number of regulators, they rely on audit report, but is the scope of work of audit report, is it tailor-made for what the regulators are looking at, right? Senior management, they would rely on the audit report in a number of ways, but is the audit report meant for them? And at the same time, employees, for example, existing employees, and even new joiners, let's say you want to join XYZ company, and is it a good way to assess company's position if you want to join them? Do you go through their financial statements or audit report? Is that the right way? So there are a number of ways where a number of stakeholders rely upon the audit report, most of which is not correct. That shouldn't be happening. And basically, we are over-relying on the audit report, and that's exactly what is called expectation gap, and we need to mitigate that gap. So basically, there shouldn't be any gap between what the actual audit report is and what the stakeholders' expectations are, right? So once the company prepares the financial statements, it gets audited, right? As I mentioned earlier, financial statements get audited by a third party, independent and qualified auditors, right? And then what auditors do, they provide audit opinion, whether the company's financial statements provide fair and transparent view of the financial position of the entity, right? Now, there are types of opinion that we're going to go through momentarily that will tell us what are the opinions that will enable us to understand more and more, and eventually that will help us to mitigate the expectation gap. So what are the opinions? So first of all, we have got unqualified opinion, right? Now, an unqualified opinion is a clean opinion. In other words, in layman language, it's a clean opinion. Financial statements present fairly in all material respects the financial position and the results of an entity. Okay, that's unqualified opinion. So auditor would come, they would perform their audit procedures, and then they would find out that according to the scope that was predetermined in the engagement letter, they have found the financial statements of the auditee in a fair and true manner, and they would provide unqualified opinion. So that's unqualified opinion. On the contrary, we have got qualified opinion, and this is where the financial statements contain material misstatement or omissions, where readers should regard the statements with caution, and the reason for all qualified opinion will be provided in the audit report, based on which the audit report will get qualified. Obviously, for the auditees, it's not a desirable opinion. That's not what they are looking for, right? So they will strive for unqualified opinion. But obviously, depending on the results of the audit work and the procedures that the auditor will perform, they can issue a qualified opinion. And then thirdly, we have got adverse opinion. Now, what is an adverse audit opinion? That's when the financial statements do not fairly present the financial position as a result of the operations or changes in the financial position, okay? And obviously, as the name indicates, it's an adverse opinion that's even worse than a qualified opinion. So these are the three major opinions in our audit report. Now we know what is an expectation gap. Okay, so an expectation gap is when the stakeholders are all relying on the financial statements from a different perspective, while it's not meant to be. It's meant to be for the shareholders to tell them how their management is managing the company, and the financial statements which have been prepared by the management, do they give the true and fair view of their financial position? That's what it is, right? Now, we know the expectation gap. We know what external audit is, what are the different types of opinion an auditor would provide. And then finally, it comes down to how to bridge the gap, how to bridge the expectation gap. That's very important, okay? We need to make sure the auditees and all the stakeholders, they are not misinterpreting the audit opinion and the audit report. They are not over-relying, because what happens is when they over-rely, they end up in making decisions which could not be desirable for them. So then we need to mitigate the gap. Now, when we talk about mitigating the expectation gap, it's a range of measures which need to be taken by a number of stakeholders. It starts from the regulators, the accounting bodies, to individual accounting firms, to the general public, how to educate them, who is going to educate them, the local accounting bodies, right? We need to keep working on it, to keep educating our stakeholders how to mitigate the expectation gap. And this is where when the auditor goes to an auditee, and they have to explain it to them, and to make sure that what are they expecting from the audit? Whatever they are expecting from the audit, is that reasonable, right? And is that fair? Is that what they are going to deliver at the end of the audit? If not, then they have to educate their clients. They have to tell them that's not what audit means. So it's the whole education thing for the stakeholders that auditors will have to keep working on to mitigate that gap. Okay. It is pivotal for the users of the financial statements to understand the following points before putting any type of reliance on the audit report. Okay. So number one, provide a reasonable assurance, not absolute. Okay. So all the accounting fraternity members, they would know and they must know that the auditor provides a reasonable assurance. So the assurance is not absolute. And this is very meaningful. These wordings are very, very important for us to understand. It's reasonable assurance, it's not absolute. Had it been absolute, okay, the auditor is providing 100% assurance, and then that would give us the peace of mind to the readers of the audit report that the entity has been audited from A to Z and it provides us absolute assurance. But if you pay attention to the opinion, it says reasonable assurance, okay? And why it's reasonable? Because it's not absolute. In other words, we cannot rely on it 100%, okay? So this is what we need to tell the audit team and all the stakeholders who are relying on the financial statement by any means. They need to know this is not an absolute assurance, but only a reasonable assurance. Okay. Scope of audit. We need to see what is the scope of audit, because whatever audit procedures, sampling, testing, risk assessment, whatever the auditors do, that is based on the scope of work. Okay, which is very limited. We need to bear in mind the scope of work is limited to the reasonableness of the financial statements. Okay, had the scope been different, the results could have been different. But for now, the external audit scope is to see whether the financial statements give true and fair position of the financial affairs of the entity or not. And that's the scope of audit, okay? A banker cannot say, I am going to lend X amount of money to one of my clients based on the audit report because it gives true and fair position. Yes, for sure, it could be one of the tools that the auditor or the banker, the lender can use, for sure. But that should not be the sole basis of lending. Otherwise, they can misjudge, they can, make decisions which would end up in defaults, which is obviously not good for the bank. It's not good for the borrower as well, right? Sample basis. That's very important for us to understand. The auditor, when they conduct their audit, it's based on sample work. Okay, it's on sample basis. What it's telling us is, let's say if there are 1 million transactions which have happened during the year, the auditor is not going to go and check each one of them. Okay, they come up with a sample size, okay, and they perform their work based on the sample size. Yes, it's subject to changes. It depends on the results from the sample size. If they perform the audit procedures on the sample, let's say invoices, and they find ambiguities, they find red flags in there, they can definitely increase their sample size. But if everything goes well, they most probably stick to their sample size, which was predetermined. And basically what happens is they do not go through 100% of invoices. So what we are trying to accomplish here is to understand that the audit does not do a wholesome work. It's only based on sample work. And once again, the reliance should be very reasonable. We have to make sure that we need to know what the auditor is looking for, okay? And their opinion may not serve our purpose, okay? Now, next point that can help us to mitigate the expectation gap is let the auditors know if there is a specific expectation from the audit, and the auditors will advise accordingly. Now, it's up to the auditee to let them know, what are they expecting from the audit? What are their expectations? Because at the end of the day, if the auditor is not going to deliver that, there will be disappointments and there would be a gap, which we don't want. So the auditor needs to know what the auditee is expecting from the audit. And so when they meet, when they sit together, and then they are determining the scope of work, the auditee needs to make sure if they are expecting anything else from the audit, they need to be very vivid in their communication to the auditor, tell them what they need, and then the auditor would advise accordingly. And most probably there could be other types of assignments which the auditors can do, either them or different set of auditors or advisors, where they can provide those kind of services. But obviously, there wouldn't be any gap if they communicate right from the word go. Okay. It is the duty of the management, not the auditor, to prepare the financial statements in a true and fair manner. Okay. So most of the stakeholders who are relying on the financial statements and the audit report, they assume that it's the auditor's job to prepare the financial statement. Okay. So if we can understand this point, that would mitigate the gap, the expectation gap, in many ways. Okay? The auditees and the stakeholders need to understand that it's the management who's responsible for preparing the financial statement, not the auditor. At the same time, it's the management's job to establish and maintain stringent internal controls. It's the management's job, not the auditor's job. So if we are expecting that, let's say, XYZ company has been audited, and it means the auditor has prepared the financial statement, and it was the auditor who was supposed to ensure that there are strong and stringent internal controls. Yes, they need to assess the internal controls, but in the end of the day, the responsibility lies with the management, not the auditor. Now, what are the measures that an auditor can take to diminish the expectation gap? Because at the same time that where we are like, okay, what are the auditees or the stakeholders, other stakeholders who rely on financial statements and the audit report, what are their responsibilities to understand what are they expecting from the audit report? At the same time, we need to see what are the auditor's expectations? What is their role to diminish this expectation gap? Okay. So number one, obviously, increased quality of audit standards. So they need to make sure they meet the highest standards of auditing. We have the auditing standards there, just like our accounting standards, international auditing standards, based on which the auditors perform their audit work. And if the auditor can comply with those standards, the quality of the audit work would be of high level, and that would help to mitigate the expectation gap. Secondly, the auditor needs to ensure the performance of proper risk assessment. Okay, so this is one of the pre-planning stage where they have to do the risk assessment of the entity, and if they are thorough in their risk assessment, that would mitigate the expectation gap, because they can come up with points which they can discuss with the management, and the audit work that they will be performing would be based on the risk assessment. There could be a number of risks that they would be assessing, the business risks, which includes the financial risk, compliance risk, and operational risks. that they would be assessing, that would help to diminish the expectation gap. Thirdly, they need to make sure, the auditors need to make sure there are strong internal controls in place. Okay, so yes, it's the management's responsibility to establish and maintain strong internal controls, but at the same time, it's the auditor's job to assess the internal controls, to ensure that the management has established strong internal controls, that they are in place, and they are effective. If the internal controls are not in place, or if they're not effective, they're weak, that means there could be loopholes and the entity is at risk. And in other words, the financial statements might not be presenting the true and fair position of the entity. Okay. The next thing that the auditors really need to focus on to mitigate the expectation gap is to collect sufficient and reasonable sample data. So as we discussed earlier, the auditors basically, they work on sample basis, right? They need to make sure whatever the sample they are going for, it has to be representative. If the sample is not representative of the aggregate data, it's not useful. So they need to make sure the sample is sufficient in terms of quantity and it's reasonable. It's representative of the overall data based on which they will be relying their work. If they do that, the audit report or the opinion that they would come up with, that would be reasonable, and that will make sure that it gives true and fair view of the financial statements. Right? Then lastly, to be prudent and follow the auditing standards in the most effective manner while performing the audit. Now, if the auditors are prudent, right, and if they follow the auditing standards, right, it really helps to perform quality audits. And if the audit is of quality and high standard, obviously it would lead to lesser expectation gap. Okay. So we have covered most of the topics here. In fact, all the topics here, which were part of our main topic, which was the expectation gap in auditing. So today we went through the expectation gap. What is an expectation gap, right? What are the factors there? What is the role that can be played by the stakeholders to understand what are they expecting from the audit report? What are the ways where the auditors can help to mitigate the expectation gap? So with that, we will be winding up this webinar session. Thank you so very much for being with us. Our marketing team would reach out to you and they will share the video on our social media platforms. Thank you for being with us and looking forward to seeing you in our next upcoming webinar soon. Thank you very much. Have a wonderful day.